Discover the power of deal analysis with myapp.property. Let's look at a property from iGrow, a new build in Sandton. And what I'm going to do is I'm going to use the myapp.property to analyze this deal and to show you why a new build is not necessarily a great investment, as much as iGrow and all of these companies that sell new builds try and convince you that it's an incredible asset. It's not necessarily the truth. So here we're looking at a property in Sandton. It's called the Black Brick. And obviously, like always, these websites are very pretty. It shows this serene lifestyle, and it talks about it being such a great investment, but you got to look past the fluff and the prettiness, and you got to look at what the numbers say. So let's see. Fully furnished, save up to 81,000 in attorney fees, rental assist, gross yield up to 12%. That's actually not bad. That's probably one of the stronger gross yields I've seen. No transfer duties payable because they just included in the price. Gross income. Okay, let's see. Only 15% excluding VAT management fees. So this might be a Airbnb opportunity then. I wonder. Okay, let's see if they give any kind of numbers, but there's the building. It's in prime location in Sandton, which is a beautiful area. Lots of facilities, nice nightlife. I think there's a good value proposition here. If you were to live in Sandton and wanted to live in a very nice lifestyle, I think buying yourself one of these apartments makes a lot of sense. Okay, so it's a 4-star hotel. So this is more like an Airbnb as opposed to a long-term rental. But let's look at the one beds. So one beds are priced from 1,270. Average unit size is 37 square meters to 59, so it's very small. Rental income of 11,000. Levies, rates. So let's just quickly work out the yield on this. So if it's getting 11,300 times 12 divided by 1,270, that's a 10.5% yield. So it's not going to be cash flow positive. Definitely not. What iGrow and a lot of these developers like to do is they like to work out their bond over a 30-year period, which, it's fine, but they're trying to justify that it's an okay cash flow deal when in fact it's not. It's going to run at a negative cash flow. Anyway, so I'm going to go over to myapp.property. I'm going to analyze this deal, but I'm going to use 20-year terms and I want to show you what the real cash flow is. So I'm on the app, and starting off, I'm going to put the asking price of 1,270. Unfortunately, there's no real discounts available with new builds, and I'm going to assume the market value is also 1,270. The buying cost on this kind of transaction will be 50,000. If you don't know how much a transfer cost is, go to the calculators tab and click transfer fees to work it out. Renovation and inspection, I'm going to call it 0. New builds don't have any upfront maintenance, which is nice, and then it'll cost 7% to manage. Now, in terms of finance, you should easily get 100% loan to value if your affordability is good. Interest rate at date of recording prime is 11.75, and I'm going to work over 20 years, not over 30 years. You can see here that the monthly repayment will be 13,763, where here they've worked it out at 12,820, right? Because they've done 30 years over 20 years. Then we go to cash flow. Now the rental income is 11,300, and I'm going to work out on a 96% occupancy rate because Sandton's in high demand. Management fees, they're asking 15% management fees. Maintenance, you can use a very low provision because the first 3 to 5 years, you're going to have almost no maintenance because it's a new build, and then the maintenance will start to grow. Levies at 1,785, and then rates and taxes at 490. So 1,785, 490. Insurance is included in levies, water, refuge, and sewage. Let's just assume all of this will be paid for by the tenant, and security and cleaning. So we're going to do some other inputs so that we can work out projections over a period of time. I'm going to use a 6% growth rate, 8% rental, 5% cost inflation, 5 and 10% discount rates, with sensitivity levels of 10% on either side. Let's go to the summary tab. So first of all, at an overview, we're getting no discount because you don't get discounts when you're working with developers. When we go to the scenarios tab, we're seeing our bear case, our base case, and our bull case. Bear case is negative, base is neutral, bull is optimistic, and based on the inputs I put in other inputs, these numbers have changed. So your gross rent on the base case per annum will be 130,000. If you get better occupancy or better real growth, your numbers will obviously change. So the gross yield, as we said on the base case, is 10.25, which is not great. And you're going to be operating at a negative cash flow, without a doubt. Let's go to the returns. So the internal rate of return is the key decision that I use to make an investment decision. And I won't do a deal under 20%, but that's when I'm looking in the lower income market, because there's obviously a risk premium there. So I want to get a return premium. I'm not necessarily expecting 20% when I'm in Sandton or new build territory, but I am expecting more than 9%. I mean, why would I put my money into property, which is risky, and South Africa Inc., the the longevity of South Africa is not guaranteed. So if I'm going to put my money into property, which is a long-term asset, into a country that's not necessarily stable, I mean, 9% is not a good enough return. I'll leave my money in the bank where I'm getting 9%. Put your money into a fixed deposit account, you're getting 9%. Why would I do that? Day one returns would be -8%. Your net present value is -81,000. So your net worth decreases by 81,000 by buying this asset. And it will take you 21 years to pay back your initial investment. So debt to equity ratio, I guess this is where the value proposition maybe sits, is that over time your debt gets eroded and your market value does increase. So you'll sit on some equity. After 20 years, it could be valued at 4 million, assuming that 6% growth rate, maintains. Your net profit, it's going to take you 13, 14 years to be cash flow neutral, to start making some money. So that's 14 years of funding somebody else's lifestyle. And on a project cash flow basis, this is really bad. I mean, it's going to take you, your cumulative cash flow is not even positive after 20 years. So this is not, I would call this a terrible investment. With a click of a button, you can also generate an investor proposal, detailed proposal that highlights all the numbers that I've shown you now if you wanted to raise finance from an institution, private lender. In the world of property investing, success likes speed, and being able to quickly and confidently analyze deals will give you the competitive edge. With this tool, you can analyze all types of property deals like commercial, multi-lets, and even student housing. Analyze cash flows, understand market trends, and assess risks, all with a few clicks of a button. Our tool simplifies data, making it accessible and actionable. This tool will help you save time, it'll enhance your decision making, and you can even learn the insider secrets of the cash flow market in South Africa. Some of the features include calculators, things like transfer fee, income tax, and affordability calculators. Analysis of deals giving you the cash flow, return on investment, internal rate of return, NPV, and all the financial metrics you need to make an informed decision. And with a click of a few buttons, you can generate a professionally designed investor proposal to help you raise finance for your next deal. Take your investing to the next level. Register at myapp.property today.